Well, good morning and welcome to the Reserve Bank. With me at the table is John McDermott, who's the Chief Economist and the Assistant Governor, and Willie Chetwin, who's Head of Forecasting. The Reserve Bank has left the official cash rate unchanged at 3.5%. Global financial conditions remain very accommodative, but volatility in financial markets has increased in recent months due to the sharp drop in oil prices, continued uncertainty around the global outlook and US monetary policy, and policy easings by a number of central banks. The domestic economy remains strong. Falling petrol prices have increased households' purchasing power and lowered the cost of doing business. Employment and construction activity are strong, net immigration remains high, and monetary policy continues to be supportive. The housing market is showing signs of picking up, particularly in Auckland. However, a number of factors are weighing on domestic growth. These include drought conditions in parts of the country, fiscal consolidation, reduced dairy incomes, and the high exchange rate. A substantial downward correction in the real exchange rate is needed to put New Zealand's external accounts on a more sustainable footing. Annual CPI inflation is expected to fall to around zero in the March quarter and remain low over 2015, reflecting the high exchange rate, low global inflation, and the recent fall in petrol prices. Inflation expectations appear to have fallen recently, and we will be closely monitoring the impact of this trend on wage and price-setting behaviour, especially in the non-traded sector. Monetary policy remains focused on ensuring inflation settles at 2% over the medium term. Our central projection is consistent with a period of stability in the official cash rate. However, future interest rate adjustments, either up or down, will depend on the emerging flow of economic data. So thanks very much. Happy to take questions. We're in a different situation. I mean, we've got an economy that's growing at around 3.25%, perhaps 3.5%. We're projecting it to continue to grow at those sorts of rates over the next 2 years. We've got a positive output gap. We've got strong employment growth. I mean, I think employment growth over the last 12 months has been around 3.5%. We've got record levels of net migration, running currently, I think, at around 48 to 50,000. We've got record levels of participation in the economy. They're at historic highs of around 70%. So our situation's quite different from a lot of those other countries that have changed monetary policy or cut interest rates. The cost of capital here doesn't appear to be a major constraint for business. And when we look at the stance of monetary policy, we still believe that monetary policy is expansionary.
Just one more on, you mentioned in the monetary policy statement the new 10-year mortgage, and there has been some concern about interest-only loans for landlords. What's your thoughts on how the banks are operating at the moment?
The duration of this market is very short. You know, we must have in terms of Macaulay duration, right, interest rate duration, must be one of the shortest amongst the advanced economies. The fact that, you know, at this point you only have 3% of mortgage holders have fixed rate mortgages for more than 3 years, for example. I think something like 55% of mortgages are either floating or maturing within the next 12 months. So we feel we still have a lot of bite through our monetary policy. Over time, I think it would be a good thing if we had longer maturities I mean, over time, in general, as we develop, greater opportunity for borrowers and investors in terms of the capital markets. Well, China has sort of probably been growing at around 7 to 7.5% or so, as best anyone can tell, over the last 18 months. They've officially reduced their forecast down to 7% for next year. We follow as best we can what's happening with property prices in China, partly for two reasons, partly because of the timber exports, the log exports that go there, but also we want to know what's happening in terms of aggregate demand and the impact potentially through on dairy prices and things. As best we can tell, prices have stabilised, house prices in the Tier 1 cities and the main cities like Shanghai and Beijing and Wuhan and some of the other big cities. But there still seem to be some softness in the Tier 2, Tier 3 and Tier 4 cities. I don't think anyone, not in this institution, is sort of thinking that China's growth is going to slow to 4 or 5%. We don't see that.